Since 2022, real house prices have fallen by 15%, and yet the market still feels broken as ever. The ratio of house price to incomes has marginally fallen, but it's still out of reach for many would-be home buyers. The big question is, how do we decide how much house prices are overvalued? We can compare house prices to incomes and mortgage payments, but a complication is that the market is also influenced by wealth, cash savings, the bank of mum and dad, and the perennial mismatch of supply and demand. In this video, we'll try to combine all these different metrics to work out how much UK houses are overvalued. The first and easiest place to start is by comparing house prices to incomes. In the mid-1990s, house prices fell to less than 3 times income. It was a unique period of really cheap housing. But since then, it has dramatically increased. There was a temporary fall in the credit crunch, but the low interest rates of the past decade saw a big increase in demand, pushing house prices up quite a lot. Using the ONS measure, the ratio is close to 8 times income. The latest ONS figures suggest that median wages are around £35,000 a year, but average house prices are £285,000, a ratio of nearly 8.2. Yet even if you were able to get a mortgage 4 times your income, you would only be able to borrow a mortgage loan of around £140,000. That means the average person would need to save a deposit of like £145,000. No wonder the average time required to get a deposit for young people has increased to 19 years. Now, a couple with 2 salaries could definitely borrow quite a bit more. And maybe one reason for the rise in house price to income ratios in the past few decades is more 2 working families. Certainly 2 adults working is more common than, say, in the 1970s. But bear in mind that mean household income in the UK is only around £39,000. And also we've seen a decline in marriage rates and more single people in recent years. But the big picture really is that for many would-be home buyers, prices are far beyond their current income levels, and this is reflected in the number of people who are living with their parents for longer. It also explains the drop in the share of young people owning their own house. During the 80s and 90s, home ownership rates rose, but has fallen in recent years. However, this method uses the share of households who own a house. If we look at the share of people who own a house, the rate is much lower, simply because many young people are living with their parents or in big shared housing. In other words, the housing crisis and unaffordability is influencing household formation. Now, house price to income ratios are one thing, but the real cost of buying depends on interest rates and mortgage payments. To understand why prices have become more overvalued, it's important to understand that in the past decade, we had this unique period of near zero interest rates. Combined with quantitative easing, help to buy, and rising wealth, demand for buying soared. Prices rose because with interest rates at 2%, it made economic sense. Buying was still much cheaper than renting. It was only in 2023 that higher rates made buying more expensive than renting. So with interest rates having almost doubled, the equation has changed quite a lot. Mortgage payments as a share of income have risen a lot in recent months. It's reminiscent of previous crashes. So when measuring the overvaluation or not of housing, interest rates is a critical factor. For example, this analysis suggests that with interest rates of 5%, house prices are 40% overvalued. The bad news is that homeowners are still remortgaging to high rates, people whose fixed rate mortgage deal ends. And as people face higher interest rates, any increase in arrears and repossessions will be devastating for the market. If you go back to the early 90s, it was really very high interest rates and the rise in repossessions which damaged the market so much. Now, the good news is that UK inflation is starting to fall, and it appears that the UK has reached its peak of its interest rate cycle. The economy is in recession and the markets are pricing in future interest rate cuts. However, at the moment, because of lingering inflation, there's only a modest reduction in interest rates forecast. There's going to be no quick return to the 2010s. But anyway, by the metric of interest rates and the mortgage affordability, house prices are still overvalued. And the market has not adjusted to the recent changes in interest rates, which are still working their way through the economy and the housing market. And it's always important to bear in mind time lags. For example, when interest rates rose in the late 80s, it took a couple of years before house prices started to fall. But at this point, a good question to ask is, if house prices are so overvalued, why does the Halifax Price Index show we have annual house price inflation of 2.5%? Well, other house price indexes are available. The Nationwide and ONS show a very small decrease in house prices. But if we combine all the different price indexes together, the general impression we get is a slight uptick in the market in recent months. If we had to define the housing market in one word, I would choose stagnation. Stagnation in prices, stagnation in transactions. But it's still a good question to ask: if prices are so overvalued, why are they not falling by much more than some people predicted last year? Well, firstly, we've had a period of quite high inflation. And this means that even if house prices stay the same, the real value is falling. High inflation has led to high wage growth of around up to 8% a year. And this means that although prices stay the same, the buying power of workers is going up. This conservative estimate suggests that the ratio of house price to incomes will steadily fall to around 7 in the next few years. But this will be mainly achieved through the effects of inflation rather than rapid falls in prices. For valuing the housing market, real prices are the best measure. And interestingly, if we deflated prices with RPI, which includes mortgage interest payments, there's a greater fall in real prices. And also, if we go back to this graph, real house prices are 23% less than at the peak of the credit crunch. And whenever I look at this graph, I always take a double glance, because it's hard to believe real prices have fallen so much, given that the affordability seems so poor at the moment. And this really brings us to the dismal state of the UK economy, the stagnant real GDP per capita growth and very low growth in real wages. Nevertheless, the impact of inflation doesn't fully explain why prices are still so overvalued. And this brings us to a slightly more difficult situation to evaluate. Demand for housing doesn't depend just on interest rates and income. The housing market is also influenced by overseas buyers, institutional investors, and people with wealth, or people whose parents have wealth. The Bank of England's own analysis suggests that quantitative easing caused real prices to be higher than without it. In the 2010s, wealth rose faster than incomes, and a lot of this found its way into the housing market because with low interest rates, it was a good investment. Furthermore, buying power has been substantially increased by people borrowing or getting a gift from their parents or other family members. The Bank of Mum and Dad has injected £54 billion into the housing market in the past decade. In 2023 alone, £8 billion was put into the market from parents, nearly half of all purchases. This means that buying power is not just determined by what's happening to your income, and it explains why there's an increased divergence between those whose parents own a house and those who don't. And also another problem is that the alternative to buying a house, renting, is pretty overvalued itself. Rents have increased substantially in recent years as household formation has outstripped supply. And if your children are paying over £2,000 a month rent, it's easy to understand why some parents would try to want to help them to buy a house, get on the property ladder. Also a big part of the British psyche. And of course, in addition to parental support, the government's own Help to Buy scheme inflated buyer demand, enabled young households to borrow more than they otherwise could have done. So the point is that measuring the market by income alone is not enough. We need to look at the effect of wealth and other factors, which sometimes are harder to actually pinpoint and get good statistics for. Now, on the other hand, you could argue that the housing market has become less attractive to investors, and the Bank of England is no longer pursuing quantitative easing. In fact, it's doing the opposite. It's selling off already £140 billion worth of bonds. And if quantitative easing pushed up house prices, will quantitative tightening push them back down? Nobody really knows the full effects of quantitative tightening until it actually happens. Also, Help to Buy has been ended, and so that's an element of inflated demand which won't be there. But will the government be able to resist the temptation to offer short-term support to home buyers? Already in the upcoming budget, I've heard talk of a 99% mortgage or using your pension to buy a house. It may not be a good idea, but I wouldn't be surprised if we see these short-term measures introduced, because the other problem of a housing market is that short-term measures are always much easier than the long-term solution of building more houses. Some claim there's a shortage of 4 million houses in the UK, and this shortage could get worse in the future because household formation is growing at a faster rate due to immigration and population growth. Now, the government have a target of 300,000 homes a year, but they rarely, if ever, get anywhere close. Unfortunately, 2023 was a bad year for building houses. Higher interest rates, falling demand, inflation. And it's almost certainly going to be less than 200,000 new homes. But unfortunately, it gets worse because the FT recently reported that due to high levels of migration, the number of homes the UK should actually be building is closer to 420,000 homes a year. And that's going to be really unachievable by any party, I would imagine. And this widening of a gap between house supply and house demand would be a factor pushing up prices, or at least preventing bigger falls. Now, this 420,000 figure is disputed. Some still claim it's closer to 300,000, but still, nevertheless, it is a factor influencing long-term prices. And of course, whenever we look at house prices in the UK, never forget it's a very regional effect. So overvaluation in the southeast may be different to overvaluation in the north. So overall, are house prices overvalued? Well, if you look at house price to income ratios, they certainly are. By historical levels, they haven't been this overvalued since the Victorian age. Higher interest rates have further reduced affordability, making them look more overvalued. And yet the market has been slow to react to these interest rate increases, not least because it's so hard to move and the number of transactions is so low. However, it's not as clear-cut as that, because there's so many other factors influencing the housing market. There's quite a significant role of wealth and cash savings and borrowing from your parents, which has inflated demand more than you might expect if you just look at income and interest rates. And this is somewhat harder to model, because when it comes to wealth and borrowing from your parents, good statistics are harder to come by. It's not as clear-cut as, say, looking at house price to income ratios. I think the most likely outcome in the future months and years is that house price affordability will slowly improve, that the overvaluation will start to come down, not so much by falling prices, but by the effect of inflation and rising real nominal wages. So it will be a slow and steady improvement, but it's very hard to see any quick return to something like the mid-1990s, when house prices were really quite affordable for that short period. Now, another factor which will have a big impact on the housing market is the state of the economy. Often recessions do correspond to periods of sharp falls in house prices. But currently we have an unusual recession in that although wages are going down and real GDP is falling, unemployment is actually very low. And so far the unemployment is quite shallow. It's not a huge drop in GDP. But the future outlook for the economy will have a huge impact on the housing market. And this video looks into why the UK economy has so many problems.